Hello, welcome in to the Road to Retirement podcast, video podcast. I'm Tony Marlette Jr. here at Brookside Tax and Financial. Flying solo today. Obviously, Chris and I alternate weeks with Tony Shore. Tony's out today and Chris is on vacation. So I thought today would be a good time to just take a look at what the market's done up to this point throughout the year. Kind of a nice halfway through 2023 market update. We send these out market updates on a monthly basis typically, but it thought it might be nice to just take a look at what everything's been doing year to date. And what I like to do is just categorize everything. Obviously, there's a lot going on. There's always a lot going on legislatively, politically. We've talked about before, we don't necessarily manage portfolios and make investment decisions based on those things, but obviously they do affect markets and the economy greatly. And that's referring more to policy than anything. So there's been a lot of noise this year and within the last couple of years, obviously, and rightfully so, about inflation. We've actually done a podcast about how we got to the point of inflation that we're at, and I believe we did that back in March or April. But inflation has been slowing. It's been really persistent, though. We originally thought, I think maybe as recently as a couple of weeks ago, that we were done with all these rate increases throughout the last year or two. So obviously the Fed increases interest rates to try to tame inflation, and they do that to try to stop the economy, essentially stop people, slow down purchasing, kind of put a kink in some of the borrowing and the lending and home building and bank loans to new businesses and to clientele, to slow the economy down, to slow down inflation. It has been very persistent, as we said, and I think right now we're likely to see not only another one rate increase. There's been some talk that there could be a 50 basis point or a full 0.5% rate increase coming up. Most of the previous rate increases have been a quarter of a percent, or 25 basis points. So there's been some talk that not only are these going to continue, but they may stay aggressive. We might see two more this year, and we could see one more in the range of 0.25 to 0.5. So 25 basis points to 50 basis points. And ultimately what that's going to do, yes, it's going to raise interest rates. So you'll see an uptick potentially in savings rates, but it's also designed to increase costs for people borrowing. And this affects homeowners, or home buyers anyway, a lot. And mortgages are already down about 27.5% from 1 year ago. There's very little inventory, as anybody really at this point who's looking for a home can probably tell you. Refinances are down 41%. That really shouldn't be a surprise. Who's refinancing when rates are going up? And then kind of strangely, first-time home buyers are actually up as a portion of the purchase market. So some of that is interesting, and read into that, what you will. But all this talk of inflation, and it has come down. It has started to come back in the right direction, but it's still really stubborn. And it's still persisting. A lot of that is going to lead into our next topic, which is what's going on with these markets. There's supposed to be doom and gloom this year. We were not supposed to see the increases that we've seen. The S&P 500 up 13% year to date. The Dow Jones up 2%. NASDAQ up 28%. And the Russell Small Cap Index up 6%. So a lot of this ties with inflation in that spending is not really stopped or slowed down at all. Earnings are still propping up the market. Strong earnings lead to strong valuations of companies, and strong valuations lead to increased market caps. So all that being said, the market's really been propped up by 7 to 10 stocks. The whole S&P 500, about 88% of the gains this year. Again, the gains are 13% year to date. 88% of those gains are being added to the index by 7 companies, and they're mainly health and technology companies. So you have Tesla, Facebook, Apple, Nvidia, Amazon, Microsoft, and Google, propping up the entire market. So those 7 stocks are 88% of the S&P gains this year, and their median performance is something like 40%. It's been quite unbelievable. So when you take that out, and that's a cynical way to look at it, if earnings stop and if valuations get back to reality, we very well could see a market drop. And then when you factor in inflation with, or I should say rate hikes with inflation and slowing spending down, if that were to happen, you could definitely see where a market correction would be coming. Now, that doesn't necessarily mean that inflation is going to be back to our average 2.25%, 2.5% by the end of this year. I think a general consensus is, we will be down around 4.5% before the end of the year on a year-over-year basis, and there would still be work to do on that front if that's the case. But overall, the market's been really good, and it's been interesting too that a lot of the dividend payers have struggled this year. Of all those stocks that I mentioned, I believe only Apple and Microsoft pay a dividend. So a lot of the dividend payers have struggled this year. I think the next, one of the other biggest parts of what's going on has been the jobs report or the JOLTS report. The JOLTS is the job opening and labor turnover survey that comes out. The numbers have been strong. Right now, there's about, let's just say as of the most recent report, they look at how many unemployed persons there are out there, or people there are per job opening. Right now, there's about 1/2 of an unemployed person per job opening. So essentially, one unemployed person, there's 2 job openings. If we put this into perspective, about as bad as it's been over the last 5 years was at the beginning of COVID. As you might be able to imagine, there were 6 unemployed people per job opening. So again, during the beginning of the pandemic, 6 unemployed people per job opening. That number is down to 1/2. So again, one unemployed person, there's 2 jobs out there for. So overall, we have about 10 million job openings and about 5 million people seeking jobs. So what's been the trend over the last really year or 2 years has been the employees really have more power. Job seekers have more power. The inmates are running the asylum, as they say. A lot of companies are starting to go back to return to work or return to office. And some of them not even going back full time. A lot of companies are saying, okay, we want people back in the office 2 days a week, 3 days a week. And this is causing an uproar amongst some employees, believe it or not. But at the same time, if you don't want to do it, there are other job openings out there. So the people have the power, as they say, the job seekers have the power at this point. So really what all this means, we talk about this a lot in context of perception. Perception is not necessarily reality, but it can be in the market. So there was perception at the beginning of this year, or even the end of last year, that 2023 was going to be a down year for the market. And it still very well could be. Suppose, again, earnings stop, the job market slows down, valuations come back down to earth. Those things could happen. I believe earnings are holding up the market right now, are propping up the market. And when that stops, which is what the Fed wants, then we're going to see a market drop. I believe earnings are the only thing holding this market up, and I think we've talked about that before. We don't manage assets based on what's going on right now. We always manage based on your overall goals, strategy, and time frame. So just keep that in mind when you're thinking about what to what to invest in, how to invest your funds, and what to look for. So this has been our half-year market update podcast for June 22nd. Tony Marlette Jr. here. If you'd like to reach us, you can do so. Our phone number, 440-886-3550. It is on the screen right now. Or visit us online at brooksidetax.com. Check out our YouTube channel and our Facebook page. Our YouTube channel, we have videos and old market updates and how-tos and instructional. Our Facebook page, we tend to keep a little bit lighter with staff bios, pictures of pets, kids, etc. So check us out online or on our YouTube channel or social media. Give us a call or come into the office. This has been our Road to Retirement podcast today. I'm Tony Marlette Jr. We'll talk to you soon.